India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, hi, good morning.
Hi, good morning. And in case you're guessing, we were trying to show a little bit of pink of health here and a tinge of teal or green on that side. We're trying to do our bit because otherwise this market is dealing with a huge onslaught of, negative to slightly difficult cues.
Well, that's right. We have our domestic challenges in front of us. But I think overnight, suddenly the US market said, let's see a day of profit taking. So we have both the global as well as the domestic headwind now. But you never know when there's a lot of pessimism. That provides the best opportunity.
I remember yesterday, we were talking about this, whether we're alone in misery or we have company. Now we have some company this morning.
Feels better, right? But I think, actually the fact is that India and the US are, in a way, the stock markets, that is, are joined at the hip. I mean, take 2022, 23, 24. These are the two biggest and the best performing markets in the world. I mean, there's a Korea which comes and goes, but Japan which has come and gone. But these are the two big markets and very high correlation between these two markets. And, we, of course, started our correction. Let's see if in the US we are starting something. So let's just sort of rewind the clock back. You've got... and start with how we closed, because that'll matter. U.S. equities down for the third straight session. The S&P was down about 0.9%. The Nasdaq was down about 1.6% as well. The WIX jumped about 5% to about 19 plus, and it's the highest since the 7th of October. After hours, you had Tesla, which came out with earnings, beat expectations. Stock was up 10%. That's a will that have a celebratory effect on other stocks as well tomorrow, later tonight, when we start trading? That needs to be seen. But that's a big stock and a big gain. So we had a bit of a sell-off early. I mean, I think it was last Friday, but through the course of the week, both yields and the dollar index has largely pushed higher. So the 10-year now, another 4 basis points last night to 4.25. And you've got the dollar index, which was up about 1/3% to 104.5. The point is, I think what's happening, of course, is the market is trying to price in a Trump victory. As I've been saying, bad for bonds. I mean, of course, anything can happen, but looks like from what he said he will do, bad for bonds and good for stocks. And if it's bad for bonds, which is playing out right now, can it be really bad for stocks? And I think the chances of a Trump victory now, of course, at least from a betting market point of view, seems to be pretty high, comfortably ahead of his opponent. In that sense, I mean, if that is what is being priced in, will that provide support to the US market? Can the US really correct into a Trump victory? I mean, I think that's a silver lining in that sense. We'll see, because there is still, things can change and it's an election and anything can happen. Last one, of course, was very, very close. And this one, according to some, is still very close to call, despite what some of these betting markets are saying. Dollar going up means that the JPY is coming off, and how, right? I mean, the dollar JPY cross is up 7% month to date. That's the Japanese yen currency we're talking about. Got to about 153.5, and then it kind of came off a little bit. So respected that resistance. Oil prices are down 1% to about 75.2, but there is still some comments here and there. The US is trying to avoid a conflict, but there are still stray comments here and there coming that, we will retaliate against Iran, etc., from Israel. So I think on watch in that sense. Here in India, just to tie in the levels, we closed about 150 points off the intraday high yesterday. Again, extremely volatile session. The support comes in at 24,132, which is the daily lower Bollinger Band. That is the support. The resistance comes in at 24,270, which is the 40-hourly exponential moving average. Bank Nifty, it ended with minor cut yesterday. It did not break below 51,000. If you do break below 51,000, then you're looking at a test of about 50,194, which is the 7th of October low. And the important resistance here is the simple 20-day moving average, which stands at 52,004 as of yesterday's close. So very tight ranges here. And I think we just need to give it time for the market to tell us what it wants to do. Hopefully, with the 7-odd% correction that we've already seen on the Nifty, the best that can happen is that we've kind of hit some kind of a bottom, and then you go into a time correction. But first, you got to find that bottom before the market starts to stabilize, and then it may flatline for a while. That's fine, but we are not in that phase yet. GIFT Nifty will come up on your screen, and that'll give you a sense of how we're likely to start. 60 points higher on the GIFT Nifty. Surabhi.
Yeah, I don't know if this is exactly how it plays out. The bulls would love that 60-point higher start, but even looking at the Asian market screens this morning, not quite playing out as per script. A lot of the markets, the China-related markets, for instance, they're down and out. Hong Kong, mainland China, many of these markets are weak. The Nikkei is not doing anything, absolutely flat. You're seeing Taiwan there also with a tinge of red. In terms of some additional data out of Asia this morning, you have the South Korean third quarter GDP numbers are not looking good at all. I mean, the South Korean economy has just about averted the definition of a technical recession. Growth is just 0.1% in the third quarter. It's well below estimates. So and that's one more concern. By the way, on the currency front, this huge surge in the dollar has meant a weakness on the yen. And the dollar-yen equation is very interesting because the yen is at now a 3-month low versus the greenback. Okay, let's talk about the numbers that are on your screen. And this is a big problem for the market. It's simply not going away. Remember, yesterday we were talking about how the market was cruising till about 2:30. And in the last 1 hour, we had some large cap selling. And it's showing up in the numbers again, about 5,600 crores down from the FPI side, and domestic institutions continue to offer some semblance of support. The problem is the market has become a sell on every rally market. That's become the nature. So the bounces are getting sold into. Two important trends have emerged from the earnings season so far, and they both don't look good. One of them is the fact that there is a broad-based consumption slowdown. It's showing up in management commentary in numbers. Urban is a talking point. And the second one is this asset quality issue that's showing up across NBFCs, lenders. Most are reporting rise in provisioning, rise in slippages. If you look at the numbers that were reported yesterday, just some of the big ones, these concerns were showing up in the HUL numbers as well. The volume growth has missed the mark, slightly missed the mark at about 3%. The EBITDA margin has dipped. And even if you're looking at the revenue growth, what are we talking about? We're talking about growth of just 1.5% on revenue for such a large consumer giant. That's telling a story. The question is it ending in one quarter or not? And that's going to be the point of debate as we go forward as well. But the management is acknowledging this slowdown, especially in the urban markets. Look at VIP industries. I mean, as Mangalam called it, it's a howler all the way. I mean, you've got losses at the EBITDA level, losses at the PAT level. Clearly, some company-specific issues there as well. Look at Pidilite. Again, volume growth is below estimates. 6% versus the estimates of about 10%. Of course, Pidilite is saying maybe it was because of the rains and, that impacted this particular company specifically. Large point is there is slowdown. Come to the financial numbers that we saw. I'll just take two. Case in point, Piramal Finance, margins are fine, but again, you're seeing asset quality stress even here. Even their, net interest income growth was okay, but it's all about asset quality. And I think AU Small Finance is going to grab a lot of attentions and headlines today because there's a marked increase in slippages and credit cost. Slippages of the annualized slippage ratio has crossed 3%. And if you're looking at the credit cost, particularly on the credit card segment, that's shown a massive increase. It's 90 bips higher than what the company had guided for. So unsecured stress, MFI stress, all of these have emerged as major, major concerns. Quick check on today's numbers. We have a busy day ahead. Let's put the list up for you. There's ITC, there's IndusInd Bank, there's NTPC, three big nifty names. There's Colgate, there's Godrej, and there is United Breweries. By the way, on numbers, I think the one that didn't miss by too much of a margin was kind of okay was United Spirits. So that one looked better than a lot of the other FMCG and other consumer names.
Well, in terms of an approach to trade today, I think that GIFT Nifty suggesting the 60-point gap up, you shouldn't be chasing that because if you want to buy, you'll get an intraday dip. That's what the screen is telling you. And if you're trading, you trade only if you're very brave, because if you're looking to buy that dip. Well, let's focus on the two top cues that we got overnight. One is the US yield, the 10-year yield. That's moved to a 3-month high. You also have the dollar index that's at a 3-month high. That's not great news from an India market perspective or an emerging market perspective. Yesterday, what happened? The FI sold yet again. And, if you're looking at the futures data, well, there was unwinding of positions both on the Nifty as well as on the Nifty Bank. So a couple of factors that are playing out here, lightening of positions in the futures market, and you have the FIs that are selling in the cash market. That's what's playing out. What did they do though in the F&O market? The FIs in yesterday's trading session on index futures, they added some mild longs, some shorts as well, though they continue to remain net short on the index. So the FIs are net short. And the clients, they are holding at more than 2 lakh contracts on the long side. The FI short positioning, well, it's not in an extreme. You know, if it was at 3.5 lakh contracts, then that is an extreme. So it's actually far away from those levels, though they continue to remain net short. Options data comes up for you, and this is important today because the weekly expiry plays out, and both these two strikes were fairly active. 24,500 call, 24,400 put, both of them active. And on the 24,400 put, the premium came down to around 65 rupees. So you just punch in these numbers, you'll get your support zone. So for today's trading session, the 24,340 mark becomes extremely important that it holds out. And in case you see a bit of a bounce, we need to get past the 100 EMA, which incidentally is around the options data resistance as well. So that's the important mark that you want to look at. If you want to buy, you'll want to buy closer to the lower end of the range, rather than chasing the gap up. The Nifty Bank yesterday it showed signs that it was going to run away, and then after a couple of hours, it just fizzled away. So on the upside, the 150 and 20 DMA, they'll become resistance zones in that order itself. So you wanted to trade above the 100 DMA mark. Stocks that I'm looking at, HUL, yes, there's a slowdown. Yes, there's, the commentary wasn't very, very good. But in the last 1 month, the stock is down closer around 12%. So how much of the bad news is in the price? And in times like this, there is a flight to quality. You want to find some hiding spots as well, stocks that have underperformed as well. So maybe, if it starts off in the red, intraday, you could see a bit of recovery on HUL. But don't chase the gap up. If you want to buy, you'll get an intraday dip.
Okay, all right, Nigel, thank you very much for that. So that's the setup as we see it. Richard Harris is now joining us. He's Executive Director at Port Shelter Investment Management. Richard, good to have you with us here. Thanks very much for your time. What's happening in India is happening. We're about 7-8% off the highs on the Nifty. But in the US, do you think with Trump ahead, at least as far as betting markets are concerned, that provides some kind of a support to the US? Because that's also a market which to many is very concentrated, very overheated, has done very well. But despite all of that, does Trump in the White House, potentially Trump in the White House, provide support?
I'm not so sure it does. There are a lot of comments about these are Trump stocks and these are going to do well. But let's not forget that the stock market's done extremely well under Biden. And the issue with Trump is that he's very mercurial. We don't really know what he's going to do. He changes his mind every 5 minutes about things, depending who last talked to him. So it's very difficult to predict. I'm not one of these who thinks that one candidate or the other is going to be better or worse for the economy. Long term, I think Trump will be much worse because of the issues regarding inflation and immigration, which are very inflationary. But in the short term, I don't think it's very easy to say that one or the other is going to do better. What we do know is that the election is having quite a big impact, I think, on the markets where people don't really want to do very much. And when people don't really want to do very much, then the air tends to come out of the market.
Richard, hi, morning. Great to have you on the show today. The other interesting facet is this rise in yields, right? I mean, look at what the 10-year is indicating. It's definitely saying something at now 4.25%. What do you think is propelling this move in bonds? Is it the sense that maybe the Fed will not be that aggressive in rate cuts, or is it something else?
Yes, again, I think it's all a bit of a delayed reaction. I think the market, don't forget that we went from the market expecting 4 or 5, maybe even 6 25 basis point cuts this year, and we've had one jumbo cut at 50 basis points, and the Fed's basically saying, right, we're going to stick there. So I think the market, on the one hand, has done very well in terms that it wasn't massively disappointed by the first. But now I think reality is setting in, and that it's looking at the economy still reasonably strong, that rates are likely to stay where they are, or maybe be very small cuts. And I think that what we're seeing now with the Treasury move and the dollar move is really people coming back into line with what maybe they've been previously. So I think we're really following on from news we've had before, rather than it telling us anything specific or anything real. If there is something you can get out of it, and I think that links with the rise in the gold price too, is that I suspect that with the rise in the long end, and the rising gold too, that there's a little bit of an inkling out there that inflation isn't beaten, that we may be at a bit of a low at the moment, and we may actually see it move ahead. And if that happens, then 2025 could be a very different year.
Hi, Richard. Morning and good to see you in. You have been quite positive on the Indian markets. And now we are down close to around 6.5%, 7% from the recent peak. What's your take on the Indian markets? Is this a good entry opportunity for someone like you has been calling a structural bull market here in the Indian markets?
Well, I think we've got to see what's happening in the rest of the world. India's been very good because the rest of the world has been very underpinning. The economy's been strong. And let's face it, if you look at the IMF growth figures that came out yesterday, day before, we're looking at India still being the standout market in terms of GDP growth and size of population, and that's a big impact, I think, on world growth if you put those together. So I think that the growth is there, but it's going to be difficult, I think, for India to buck the trend if the rest of the world is maybe holding back a bit. What we've had, if you look at this year, we didn't think much of this year. But we had a big AI rally. We've had a big turnaround in what we think about the consumer, big turnarounds about the fact that actually there has been some growth in Europe and in the US as well. All of these have been positive events. At the moment, we don't really have a positive event out there. And we do have the US election hanging over us. So I think it's not surprising that markets are going to languish at the moment. And India is no exception.
Okay, all right, Richard, we'll leave it there. Good conversation as always. Thank you very much for joining us here on CNBC TV18. Guys, the big reason why the markets dropped is, of course, FII selling, right? $10 billion plus has gone out. Mutual funds have bought $10 billion. Yeah. Actually, it's very, it's stark. 90,000 crores buy, 90,000 crores sell, right? Yeah. If you see. If you remember, we were talking about if this money has gone to China, I remember somebody saying that the readjustment will take about $10 billion. It's about the readjustment from India to China is about $10 to $12 billion. I think about 10, 11 has already happened. So actually, can we do it mathematically? I don't know, sitting here. But I don't think anyone can do it. But I think broadly you can, if those numbers are correct, we'll have to go back and see. Because the question people are asking is this it? 10 is done, 11 has gone out. Is there more coming? Will we see another week like this? And I think to that sense, my sense is maybe mostly it is done. We'll have to see this readjustment that we're talking about. FI is on about $800 billion here. It's not as if they're going to move 800 billion to China, right? Yeah. So it's just 1-2% of the MSCI emerging market universe. Yeah. And that percentage going from 27 to say 25, 24, that's worth this $10-12 billion. But bulk of it has happened. That's the limited point. India to China, if you find valuations in India expensive when you want to sell, that's a different point. Yeah. But this readjustment, I think, is largely maybe done.
And we're not seeing a tearing sort of rally continue in China. We'll see what happens with more policy stimulus. But I was with a bunch of money managers yesterday, and a very large sort of foreign asset manager here in India. And we were talking about how domestic institutions have been providing that cushion, right? Yeah. If it wasn't for the domestic buying on a daily basis, imagine where the Nifty would be with this $10 billion selling. And any guesses on which tier 2 city is becoming sort of a massive hotspot for fresh SIP additions or incremental SIP flows coming in, which is where their sales teams were directed, and they're doing these offsites. Yes, it's a city in the northern part of the country. Any guesses?
Varanasi.
Patna.
Patna.
I mean, there's a huge amount of sales momentum over there, and that tells you the story of what has changed in this market. It's changed for the better, and perhaps it's changed for good. Well,
and I would side with Prashant on that FI point, actually, because if that hot money needed to move, I think if that majority of that hot money is out of the system, that's what the numbers are telling you numerically. So we'll have to see how that goes. Hopefully, that selling just reduces from here on. But $10 billion is a lot of money, and I think the holding would be at around 16.5% to 17% after this 10 billion is out of the system.
Absolutely. Well, we'll track the numbers. We'll sort of get your opinion from fund managers, investors who look at this kind of data, etc., because it'll give us a sense at a high level of what's happening, because a lot of money has already gone out. But is it done? Largely done is the question. Let's quickly tell you what's lined up in terms of corporate interactions as well. So at 8:35, we'll hear from Sandeep Agarwal of Sovilo Investment Managers. We discussed mid-cap IT earnings. Yesterday, Coforge and Persistent blew the lights out, Coforge especially. 9 a.m., we'll be joined by Abneesh Roy of Nuvama Institutional Equities. We talk about FMCG. and of course, second quarter earnings of HUL. At 9:20, we'll have Ashwini Agarwal of Demeter Advisors, LLP, and he'll be our market master of the day. We talk stock sectors. 9:30, Metro Brands discusses their second quarter numbers. KPIT's Kishore Patil will be talking to us at 9:40 about their second quarter performance and the guidance as well. And after that, 9:50, Gaurav Pandey of Godrej Properties talks about their second quarter earnings as well. Indianomics at 10:15, and my colleague Lata will be in conversation with Vishrut Rana of S&P Global Ratings, Santanu Sengupta of Goldman Sachs, and Chetan Iyer of Morgan Stanley. And they talk about the India sectoral bets in the economy in summer 2081. So it's a packed show.
Well, we get into a short break, but we've got a lot of stock-specific action to track for you. We get to that in a wee bit from now in our special Top 10 segment. I'm running through the list for now. TVS Motor, Pidilite, Escorts Kubota, Sona BLW, AU Small Finance Bank, Dr. Lal Pathlabs, Aster DM, and Naveen Fluorine. On a day like this, 8 stocks are expected to do relatively better, while you have HUL United Spirits that will be reacting to a weak set of numbers. Stay with us. We get into detail on the other side.
Welcome back. So global cues are slightly challenging. We've been telling you that. Despite that, the implied open suggests it's going to be a positive start. Let's see if we get it or not. Lots and lots of stocks on the radar. Plenty of earnings to go through. So let's straight away get to the CNBC-TV18 list of top stocks to watch this morning. And we have our team standing by for exactly that. Guys, good morning to you. Manglam, off you go first. HUL. So I think we have to go far beyond the first headline, which is just 1.5% top line growth. Looking at all the internals, how do you sum it up?
Well, the only way to sum it up is that macros are weak, because you can't blame the company, when there is an urban slowdown, and across the board where you see it from either Nestle, Tata Consumer, or the other companies that I'll be talking about right now as well. So revenues, 15,500 crores. The street was working with a number of 15,665 crores. Not that the street was expecting too much as well, but these numbers have come slightly shy of expectations, and a large part of that could be attributed to sentiment weakness itself. Volumes have grown 3%. The street was working with 4 to 5% growth. Even the EBITDA and the net profit, as a result of which, have been slightly shy of expectations. In that as well, a couple of segments of the company did extremely well. We had beauty and wellness do extremely well for them with a 7% growth. Home care grew by about 8%. It was personal care where the company had to do some price cuts, and food and refreshments where, tea has been facing some challenges which were under pressure. So let's see where this comes about from here, because the management has called out some inflation in raw material and low price growth going forward. My sense is that the stock opens mildly in the red, but thereafter stabilizes, given the fact that it's already corrected 10% from its highs.
Okay, all right, Mangalam, thanks a lot for that. Well, the other one we're focusing on is TVS Motor. Sudarshan, yesterday those numbers looked disappointing, but I think the management in pockets in that con call was sounding fairly optimistic. Tell us more about TVS Motors.
Morning, Nigel. So TVS had reported earnings just during the last hour of the trade, and earnings were slightly lower than estimates, but commentary looks positive. So what everyone wants to know, how is the demand during the festive season? So TVS is saying that in the Navratri period of in those 9 days, industry's demand was 11%. The growth was 11%. After that, there was some slowdown, and so far in the festive season, industry's growth rate is 4%, while company has outperformed. Now it sees demand improving during Diwali, and for Q3, growth rate for the industry as per TVS is seen in the range of 7 to 8%, and to which company is saying it will outperform the industry. Regarding the exports also, there is one positive comment. Africa, which forms 57% of exports revenue, company is saying it has hit the bottom, and now it's seeing growth is expected to see from Q3 onwards. And regarding the launch also on three-wheelers, company is expected to launch three-wheelers electric vehicles very soon. So overall commentary looks positive after an inline to slightly miss on earnings front.
All right, Sudarshan, thank you very much for that. Well, let's go back to Mangalam, because there's more from the FMCG in consumer space, Pidilite and United Spirits. Mangalam, morning again.
Well, the headline for both of them would be soft revenue growth. If you look at Pidilite as well, revenues grew by about 5%. The street was working with a growth of 6% odd. The EBITDA came in largely in line with expectations. The margins at around 23.8%, and the net profit at 540 crores as well. What was soft? Consumer business. Volumes grew 6% versus expected 8 to 10% growth. What did well for them was, one, there was expansion of 300 basis points on the gross margins, and the B2B business grew by about 21% in terms of volumes. So that's a positive. The company remains optimistic for the second half. For United Spirits as well, the prestige and above volumes actually declined by nearly 4% as against flattish expectations. Popular was down by about 8% as against expectations of 6 to 8% decline as well. On the reported front, these numbers were largely in line with expectations. Expect the stock to open in the red, but thereafter we may see some recovery, largely because the second half for spirits sector is extremely good, and then you have the tailwind of the Andhra regulation coming in force as well. So opens in the red, may see some recovery.
Okay, it seems, it's only when Mangalam talks about jewelers is when the growth conversations kick in. Apart from that, everything else in consumer seems to be subdued, right? Just the jewelers, right? That's the only standout.
Just the jewelers, because people are a little conscious as well now. They're looking to save via gold. Over the last 1 year or so, we've seen a 30% rally in gold prices itself. So jewelers are doing well because the formalization theme is playing out. There too, though, the margin expectations are weakened because of lab-grown diamonds and the decline in diamond prices.
Okay, consumer headwinds. Mangalam, thank you very much for that. Let's go back to Sudarshan now. The news on escorts and Sona BLW is out. Sudarshan, fill us in.
So it's been a long pending deal. First time CNBC-TV18 had reported about this deal in October 2023 that Escorts was looking to sell its railway business. And after that, again in September, we did report about that Escorts Kubota has been in talks with Sona BLW for the railway business deal. Now, yesterday, this news break is confirmed and both these companies have announced the deal. So what is the deal? Escorts Kubota will be selling its railway business to Sona BLW, and deal is done at an enterprise value of rupees 1600 crore, and it will be done on a slump sale. How will this deal be funded? Recently, Sona BLW had done QIP, and through that they had raised 2,800 crores. So this deal will be funded by QIP and internal accrual. So what does this deal do for Escorts Kubota? So basically, its parent company Kubota has been wanting to sell railway business because they wanted to focus on the core segment, that is agriculture and construction. For Sona BLW, it says this railway business acquisition of railway business of Escorts Kubota will be earnings accretive from the very first year. Also, it will enhance because it wanted to expand the mobility segment, so the acquisition will help. Lastly, talking about the Q2 results of Sona BLW, results have been steady. Revenue was driven by scale-up of EV program. Order book as of Q2 was rupees 23,000 crore, and new orders in Q3 have come in at rupees 1,200 crore. So overall, it's positive for both Escorts Kubota and Sona BLW as far as the railway business deal is concerned.
Okay, so going with green on both those two. Thanks a lot for that, Sudarshan. Well, let's hop across to Abhishek. He's here to tell us about AU Small Finance Bank. Abhishek?
So Nigel, to begin with, AU Small Finance Bank operationally a strong quarter for them with reference to the net interest income to the operating profit level. However, slippages or asset quality have deteriorated for them. That is in line with what you are seeing with other players in the unsecured segment as well. So slippages increased more than 35% on a quarter-on-quarter basis. The annualized slippage ratio came at more than 3% in this quarter versus 2.4% in the previous quarter, and that is why you saw the gross NPA ratio inch up by 20 basis points sequentially to about 1.98% versus 1.78% in the previous quarter. On the guidance that they have given out for FY25, the guidance on net interest margin has been increased to around 6% from 5.7 to 5.8% earlier. However, the credit cost guidance has also been increased to 1.3% versus 1.1% that they had earlier. This is on account of the fact that unsecured book had a credit cost of about 8.3% in Q2 FY25. So they have inched up the credit cost guidance on unsecured portfolio to 8.5% range in H2 of FY25. So on their numbers, the PNL is a beat on our poll. Back to you.
Okay, all right, got it. Thank you very much for that. Abhishek, we'll watch out for AU Small Finance Bank. We have Vinny now joining in with a bunch of other stocks in news. I'm sure plenty of them are on earnings. Vinny, good morning.
Absolutely. All the three are on the back of earnings and they're pharma companies. So first we have Dr. Lal PathLabs. We are expecting a bit of a positive move here. Revenue came in line with estimates. While we're seeing the profits was better than estimates, margins have seen an improvement of 70 basis points. The company has guided for around 11% year-on-year basis growth for FY25. And strong results were seen even in the tests per patients, and Swasthfit had seen a very strong growth for the company. So it's interesting to watch out for Dr. Lal PathLabs, though the company has highlighted a bit of an increased competition from hospitals in the diagnostic space. That is something that we should be watching out for. Aster DM, that also seen a strong growth coming in, 17% revenue growth, sharp improvement in terms of margins, EBITDA margin around a 500 basis point improvement on a year-on-year basis. And overall, the core business, that's the hospitals business, I beg your pardon, as well as clinics business, that has seen a very strong growth and driving the growth for Aster DM. So we're expecting a positive move here. Other than that, Piramal Pharma also we're expecting a positive move. The revenues have seen a good growth, 15% growth year-on-year basis. Profits of the company have seen a very good jump up. 22 crores is what the profit has come in at, was last year of just 5 crores. The CDMO business of the company, that's doing well, 24% growth there in quarter 2. And biotech funding, that started seeing an improvement. That's the highlight coming in from the management. So we're expecting a positive move in Piramal Pharma as well.
All right, Vinny, thanks very much for that. So keep an eye out on Piramal. Naveen Fluorine is the next one. Sonal is standing by. Sonal, morning.
Good morning. Well, Naveen Fluorine's numbers not as bad. In fact, we've seen a YOY growth for the company. Revenues improved 10%. We had an EBITDA growth of 10%. Margins flat on a YOY basis. Profits were down, but that was because of higher taxes. And sequentially, we've seen a growth this time around. But it's the chemicals business which has seen a degrowth again, down 15%. But the HPP revenues were up 23%. CDMO revenues were up 41% for the company. company to come in at 68 crore rupees. In the conference call, the company also mentioned that there's strong order visibility based on firm orders for Q3 and Q4. That is the case for FY26 as well. Brokerages, though they have cut the EPS estimates, they are positive on the forward-looking outlook. Citi says pick up in the CDMO business and they expect commissioning for the new R32 plant in February 25 to augur well. They also talk about, Jefferies also talks about the commencement of 2 new contracts in CDMO in the fourth quarter that should jumpstart growth. So positive commentary is something that should keep the stock in green.
Okay, all right. Got it, Sonal. Thank you very much for that. Let's quickly recap our list of stocks to watch this morning. The ones that have positive news flow around them are TVS Motors, Pidilite, Escorts Kubota, Sona BLW, AU Small Finance Bank, Dr. Lal PathLabs, Aster DM, and Naveen Fluorine. The ones that have negative news flow around them are HUL and United Spirits. Okay, so that's the stock list to start off with. What about commodities? We have Manisha joining in with a roundup of all the action. Manisha, I was just taking a look at oil. I mean, there's a rebound this morning, and now Brent has quietly gone back above 75.
Oh, well, yes, it has. Last week was a 7% decline, but this week until now it is a 3% of gain that the crude oil prices have put across. Well, uncertainties around Middle East conflict are clearly supportive, and then markets have seen Chinese data, which has been positive all around for the month of September, telling you that the Chinese demand could also perhaps pick up. And then there is some short covering as well with the kind of sell-off that we saw in the previous week. Markets will also watch out for dollar index going further because that one is trading at a 2.5-month high. Also, the U.S. inventories have shown an increase. The production in U.S. is near record highs as well. So the markets will watch out for the prices from here on. Having said that, I believe 70, 72 seems like a strong support, but markets still find resistance above 78. So that's the range that we will continue to trade within.
All right. Thanks very much, Manisha, for that. We're going to take a quick break here, but here's a quick small programming note as well as we take that commercial break. As we prepare to ring in the festivities this Diwali, tune into CNBC TV18's Master Market Movers Forum today at 3 p.m. onwards, featuring guests like Ramdev Agarwal, S. Narain, Nilesh Shah and others to help your portfolio prosper this Diwali. Stay tuned. We're back after that break.
Welcome back. Hope you're having a good morning. Well, we have listed on all the top stocks that we're tracking for you. So let's get straight to some more fundamental analysis. Deepan Mehta, Director at Alexa Equities, joins us on the show. Hi, Dipan. Good morning and good to see you. Let's talk about the big nifty name, HUL. The numbers were weakish. The commentary as well quite subdued, particularly with regard to urban India. What's your view on the stock? I ask you this in the backdrop that the stock has collected close to 12% in the last 1 month itself. So your view on it?
Yeah, Nigel, good morning and thank you for having me on your show. No, I think the results are very disappointing. We saw the same situation in Nestle as well. And the problem with HUL, Nestle and a host of other FMCG stocks is that most of their products are mature, and whatever gains they had to make over the last decade by expanding to the rural areas, all those gains have got captured in the earnings. And now they're going more or less in line with consumption patterns of products which are already mature. And from that point of view, it's very difficult for HUL or similar peer group companies to grow volume by more than a low single digit as well. So in such a situation, from an investor's perspective, does it make sense to remain invested in HUL or Nestle or some of the other FMCG stocks? I think it's better to move on. There are so many more choices when it comes to playing consumption. It's not like back in the 80s and 90s where only FMCG was there. So I think investors should be overweight to nil weight on such MNC FMCG stocks for the time being.
Deepan, hi. Good morning. Let's talk about slightly happier things. And I think mid-cap IT gave us plenty of reasons to smile yesterday, right? So how do you look at it? I mean, is it just a company-specific thing? Coforge, for instance, sounding so optimistic and confident, even persistent, great numbers. How would you look at IT? What would you buy, not buy? What's the advice here?
Yes, Sylvie, good morning. You know, I've been watching IT for the last, whatever, from 2000 onwards, 25 years. And whenever there was a boom in IT stocks, stock prices, as well as the industry, it was the large cap IT stocks which did better than the mid cap IT stocks. Their valuations were higher, their growth rates were higher. But last 2-3 years, the phenomena has changed completely. And now the growth rates, the valuations, the kind of qualitative factors of the mid-cap IT companies is far superior than large-cap IT. I think from an investor's perspective, you need to be into a basket of mid-cap IT in order to play that particular investment theme. And companies like Coforge, Tata Elxsi, Persistent Systems, KPIT, the common thread here is they are focusing on a specific vertical or a specific technology, and they're able to compete with all the biggies in the industry, the larger software companies. And the important thing is low base effect. So even $20-50 million contracts can make a difference. They're able to even attract talent as well. So very positive on mid-cap IT, just wanting to buy them at reasonable valuations in that PEG ratio of 2 times or so. Right now, I think they're going at about 3 times price to earnings to growth. So I think if they correct a little bit further because of overall market conditions, then that's one segment of the market one can be overweighted.
Deepan, hi, morning. So Paytm, there's I think Citi's come out with this upgrade call after the relaxation came from NPCI with regards to onboarding UPI customers. What's your call? Stock's done well. I mean, from the lows, of course, it's done well, but your call.
Yeah, Prashant, you know, looking at the overall market sentiment appears to be weak and we may be in for a correction. I'm not convinced that one should buy the new age technology stocks. Even Zomato, although we have an investment as a measure of disclosure, but Zomato, Paytm, Policy Bazaar, I think these are companies where although growth is there, but you know, valuations are always a concern, and this entire correction which we have seen is on account of valuation concerns. So from that point of view, I want to be tactically underweight the likes of Paytm, Zomato, Policy Bazaar, other new age tech companies. You could see a deeper correction over there. And although underlying growth rates are steady, but base effect also is catching up. And in markets like this, now you need to focus on companies with solid earnings, good quality businesses, which may be available at reasonable valuations, which you have missed out on perhaps earlier.
Okay. All right, Deepan, stay on. We have a lot more questions for you, but let's just dive a little deeper into that question on IT and what this season is telling us. Because yesterday, a lot of the mid-cap IT companies were, setting the screen on fire. Like I said, to name immediately would be Coforge and Persistent. Great growth coming in. I mean, these are companies that are clocking 5, 6, 7% quarter-on-quarter growth in this kind of an environment. We have Sandeep Agarwal, fund manager at Soilo Investment Managers, joining in. Sandeep, thanks so much for joining in. So the contrast is stark, right? The large guys are telling you that it's okay, just about the same, demand environment gradually will pick up. And there we're still dealing with very, pedestrian expectations in terms of growth. And yesterday we were talking to Coforge and they're talking about, doing, 25, 30, 35% this year. They're sounding aggressive, doing acquisitions. So, run us through what's going on here and which are these niche companies that investors perhaps should be looking to own?
Yeah, hi, good morning, and thanks for having me on the show. So I will agree with Dipen a lot on all the points you asked. So basically, 20 years back, as he rightly mentioned, it was large cap which always used to do well. But now some of the mid caps, which are actually mid cap relative to large cap market cap today. But if you go 20 years back, this size companies were called large cap in India. So now they have become a quasi large cap in parlance to that time, and today may be called mid cap. So they are doing phenomenally well, but I believe that, there is a bifurcation into the technology they are servicing. So I think in the ER&D space where, KPIT, Persistent, Tata Elxsi, all these names are there is a phenomenal growth because, the penetration in those industries is very low, 4-5% of outsourcing, and they are not at all penetrated. They are at the beginning of the, 2-decade cycle in my view. So that's the reason, these companies are able to deliver so well, and I think they will do well for next 10-15 years. And some of the investors take call, okay, we are willing to pay 3 times PEG ratio, which I am not willing to, but they are taking a 10-15 year call that they can multiply from here also 3, 4, 5 times, and which will eventually mean 15-17% CAGR on stock return, which is a very good return. On the other side, typical IT services companies, which even in the mid-cap space, they are not doing so well. And also, there are some IT service, the large cap IT services companies, they are into the matured business where, 20% penetration or more than that has happened. So their, growth has obviously slowed down, one, with respect to their scale, two, with the amount of money which can be put on those businesses anymore. So I think, from that perspective, these companies are trading at 1.25 times, 1.5 times PEG ratio. They are all good dividend distributing companies. So, this is the two ways the industry is today. So in my view, people are taking very long-term call on structural bets. For them, these expensive mid-cap companies are very good bets. For people who want, a stable 10-15% return with good dividend and buyback support, I think for them, the large names are very good.
Okay, so let's just dive a little deeper into the mid-cap universe. You said ER&D would be a place which investors would want to look at. And there you took two names, I think, Tata Elxsi and KPIT Tech. And Persistent. Of course, Persistent has done really well as well. Now, on KPIT, and we'll be talking to the management today as well, the fact that some of these companies could have big exposure, say, to the auto sector, right? I mean, isn't that a near-term concern, looking at the way the demand trends are shaping up? And just tell us more. So there's ER&D, you named 3 companies here. I don't know what basket Coforge fits in, but and a lot of them are now executing or beginning to execute Gen AI related or AI related work as well. So what more should we be looking at? Where to keep that sharpened focus when we're looking at the mid-cap IT universe?
So, another very interesting thing here, I would say, is that all these mid-cap companies, which are Coforge and others, which are also doing phenomenally well, I think what is happening is, as rightly said by Dipen also, that, if now for them 20, 30, 50 million makes a big difference, and, suddenly their growth rate goes up phenomenally well. And they are able to beat all other large names. Because for large names, you need $500 million or $1 billion deal to make that change in their size. So that is something which is also helping. And in case of Coforge particularly, they have exposure to some of the sectors which are on a very strong revival right now. And this company has delivered superb, growth for last 4-5 years, if you see, since the change in management. On KPIT, particularly, if you see the auto exposure is obviously a little concerning, but I would still say that because they are in ER&D, it is you should go by services rather than the industry. So services should be preferred over industry. I see this services of ER&D doing phenomenally well because the penetration and the amount of outsourcing which has happened is just the beginning. So I would say there will be quarterly hiccups, but for long-term investors, these are very good streams to be in.
All right. Sandeep, just one quick question on KPIT, because, we will be speaking to them today, but they had their con call and now they're guiding at the lower end of the range, which could be a little bit concerning. And that stood out yesterday because they didn't participate in that mid-cap IT party. It's already corrected close to, I think, 15-18% from the recent peak. Would you look to buy the dip if you get one today?
So, we run a PMS, will be very hard to call out what we will buy or not. But
no, what would your call be? What would your advice be? In terms of if you get a dip, then it would be more than a 20% correction from the recent peak. Is the stock looking attractive then, giving the longer term runway that it has?
Yes, so I think it will do, all these companies will do phenomenally well, including KPIT. Only thing is that they have very big exposure to auto, and because of that, if there is a slowdown in Europe, it may impact that piece of the business to some extent, and because of that, you have seen this correction, and we may see a little bit more correction. But also remember that this stock has moved up very, very sharply. One of the best performing stocks like Coforge in last 3-4 years. So lot of returns were upfronted. It has become insanely expensive, and I think that returning to the normal is now happening. I would say that if someone is taking a longer term 2, 3, 5-year call, I don't think these are bad stocks at all. These are good stocks to accumulate, and obviously you can't call out what will be the bottom, but there could be some more correction. But as a company and as a services they are in, it is in a phenomenal space, I would say.
Absolutely. Sandeep, we'll leave it there. Thank you very much for your time. Appreciate it here on CNBC TV18. The Coforge management, the aggression yesterday.
Yeah.
I mean, it was something. And by the way, it's interesting, as someone was pointing out, it's like they don't have a promoter now. Right?
Yeah.
It's a widely held institutional kind of stock.
Yeah.
And it's just at an all-time high, by the way, right? So,
and I think in the last, if you look at the last few quarters, he's repeatedly been very confident.
Yeah.
You probe him more, he says, I'm even
I remember
more
first quarter,
Yeah.
he was absolutely, I told Sudhir yesterday, I said, you're listening to you, people are going to be calling up the brokers to buy the stock. I mean, stock ended about 11% higher in a tough market, so that's commendable. We'll take a quick commercial break here. We're going to come back in 11 minutes. Now we're going to come back in 2 minutes, but the pre-open is in 11 minutes. Mitesh and Sudarshan are going to be joining us for some technical trading ideas. Stay tuned, that's coming up.
Welcome back. Well, Deepan Mehta is still in conversation with us. Deepan, wanted to ask you about this travel theme. There are two airlines. Some are betting on, on SpiceJet coming back as well. How do you approach this travel theme? And also a word on the luggage space, that entire shift from unorganized to organized. Safari gained considerable market share. Some would believe VIP at this price is attractive, but how would you approach it? Between airlines, luggage, do you like any of them?
Yeah, Nigel, I think this travel and tourism is a great investment theme to play. And, post-COVID, we have seen very good growth rates coming through over there. And of course, I think our preference is for the largest airline company, that's Indigo. But the SpiceJet, it all depends upon execution and how they're able to regain the market share. A lot of uncertainties over there, but could be a dark horse. But from an investor's perspective, I think if you want a stable stock for a long-term 3-5-year type of outlook, then I would still go with Indigo. And there are some niche companies, like in the travel tech space, not a disclosure we may be invested in it, is RateGain Technologies. And that offers a platform for a lot of the travel tourism related businesses to kind of manage their software requirements. That's an interesting play. At the same time, I think hotel companies, especially Indian hotels, looks very interesting, although growth rates have petered off, but long-term trajectory looks very interesting. And new ideas, I think we are looking for in the travel and tourism space. Another interesting company is this visa processing company called BLS International. That also is growing extremely well. So we need to find niches over there, but this is one investment theme we should be overweight on.
Okay. Dipan, yeah, you said it. I was just thinking in my head, listening to all the consumer slowdown talk, that ultimately, where is the money going? And I was just thinking this in the break. It's going to travel. That's why people are spending. And like Mangalam was saying, it's going to the jewelers. And maybe it's going to property. People are still buying houses, right?
And you can add air conditioners. Air conditioners.
Air conditioners. So you want to leave us with a stock name? If you want to play that RAC play, air conditioning play, then which one will you go with out of the several available options?
They're all well discovered and all very expensive. Right, from Blue Star to Voltas to Amber, I think, there is really nothing. I mean, it's all well discovered. They're quoting at 70, 80 times. A lot of growth rates have got captured.
There's EPAC also, right? Now there's EPAC. They're going to build ACs with Hisense.
Yeah.
Okay. All right, Dipan, great having you on this morning. Thanks very much. You have a good day, and we look forward to chatting again soon. Well, from fundamentals, let's now move to technicals. We have Mitesh Thakkar and Sudarshan Sukhani joining in with today's setup. Gentlemen, morning to both of you. Mitesh, it's been a slow grind down, right? And yesterday also there was no respite for the bulls. What's the advice for today?
Good morning, Suri. So, we met a very important level yesterday. I've been highlighting 24,370, 350, and we got a low of around 24,378. So that's where a couple of weekly averages are converging, and therefore I think, holding on to these levels for me is very important. What traders should look to do is possibly exit and, cut their short positions. Now, I think fresh shorting should be done below 24,330. And, but the texture remains weak. So the idea should be that, use bounce backs and rallies to possibly wait and identify supply pivots and there take short positions. To me, 24,600 is the first level, but the best shorting opportunity in case we get a stronger pullback will be closer to about 24,770, 800.
Okay. Gentlemen, morning. Sudarshan is also with us. Sudarshan, morning. How would you look at things and what would you do?
Yeah, good morning. See, for a positional trader, I think it's best to stay away. That's the view I have for the last 3-4 days. I don't actually recommend shorting this market or any bull market. But for the intraday trader, there is a trade that's emerging today, and that is to wait patiently for the first half an hour, put your stop loss below the low of the day, and then take a long position. This would be intraday. This is assuming that the markets could do something different, which is what the opening is also suggesting on the options expiry day. But your stop loss must be placed under the low of the day of the first half hour. But that is only intraday. For positional traders, stay put. Let the market decide what it wants to do. It's too early.
Okay, all right. Got that, Sudarshan. But you'll have some stock calls. So let's get to that.
Yeah, well, I have Indus Towers as my only intraday short. Consider selling it with a stop above 365. The rest are buying opportunities. This market is giving positional buys also. So focus on the positional term. Bajaj Finance is a buy, the stop under 6,800. ICICI Prudential is a buy, the stop under 735. Both these stocks had very good days yesterday. They suggest that they are bottoming out. And MCX, which is already in an ongoing uptrend, is a buy, the stop under 6,400.
Okay, got that, Sudarshan. Mitesh, back to you. Stock ideas for the day?
Yeah. On the stock side, I have buy on DVs. That's seen a stock which has outperformed and is now at support level. So buy here with the stop below 56.90 for targets of 5800. HDFC Bank remains a very strong buy for me. Keep a stop at 1709. Look for targets of 1790, 1800 to begin with. And on the sell side is About India. If it breaks 28,400, it's trading about at 28,460, 70. So below that, go short with a 350 point kind of a stop at 28,750 and look for 27,500 as the first target. And Cummins, I would want to sell on a bounce back around 34.50, 34.60 zones. So keep a stop at 35.20. Look for targets of 3300.
Just want to confirm the picks, Mitesh.
Yeah.
The last one was Cummins.
Last one was Cummins India on the sell side, which I would want to sell on a bounce back. And before that, a sell on About India. A buy on Divi's Lab with a stop below 56.94 for targets of 5800 and HDFC Bank. Yeah.
All right, got it. We buy on Divi's. Got it. We missed that. Thanks a lot, gentlemen, for that. For the time being, we'll slip into a short break. When we come back, we'll get to the pre-open rates, and we'll also get in Abneesh Roy of Nuvama Institutional Equities as we focus on the FMCG majors. As they've highlighted, demand is a little bit sluggish in urban India. Stay with us.
Welcome back. Here, this is Open Exchange, and we're coming to you live from the CNBC-TV18 Motilal Oswal studios. Well, let's quickly talk about now some additional cues. By the way, that is, that's the first pre-open rate. Let's wait for it to settle. Shouldn't be that kind of a drastic low. But yes, the cues have been negative. We've been telling you about the Wall Street sell-off and the Asian market weakness as well. We'll get in reactions. It was very early, probably not right, but for what it's worth, let me look at what Lever is doing. Like Nigel was saying, that the results are weak, no doubt, but the positioning and the approach, the stock is also sold off. So is that going to help Lever at all? Right now, it's down just about 0.5%. So let's see if it indeed manages to get by, which is that. Rates are a little all over the place on some of the large cap names. So we'll wait for things to stabilize a little bit. In the meantime, let's quickly go across to Chandan Taparia and get some F&O ideas going. He's from Motilal Oswal Financial Services. Chandan, good morning. The bears are having a field day. Last couple of sessions, actually. What's your advice today?
Good morning, Surbhi. Thanks for having me. Nifty has been making lower top, lower bottom from last couple of weeks, and levels are gradually shifting higher. Bears are dominating as every small bounce is being sold, and the immediate supports are being broken. The index has failed to surpass any key resistance zone, starting from 25,250, 24,800. And now till it remains below 24,600 zone, further weakness may continue to take the index towards 24,200 zone. So till immediate level is not surpassed and the structure of lower top, lower bottom remains intact, we believe more profit booking decline could be there in the market. Looking at the Bank Nifty index, it has been witnessing kept upside, but multiple supports are visible at 51,000 from last 10 days. So if that is broken, then the fresh leg of downside will start to take the Bank Nifty down by around 1,000 to 1,500 points. But we need to closely watch 51,000 and that can give a trigger for trade in this rate sensitive index. Now looking at the stock wise, first trade in buy on MCX. The stock has been making higher top, higher bottom, holding well above its rising support trend line. It has given a small consolidation breakout and we have positive stance in the entire capital market sector. So recommending to buy on MCX with support of 65.50 for an upside target towards 7,000. Second trading idea, there is buy on Tech Mahindra. Nifty IT has been holding the support zone and one of the strongest counter even after the market weakness. So Tech Mahindra looks strong, base is shifting higher. One can buy with support of 1680 for an upside target towards 1800 zone. Last trading idea, there is sell on Lupin, a weak structure, making lower top, lower bottom. It has given a breakdown with built up of short position. So one can sell with a stop loss of 2120 and Lupin can dip down towards 2000 marks.
Okay, well, that's basically the trading ideas coming in from Chandan. Chandan, thank you very much for that. Well, let's talk about FMCG and consumers a little bit now. FMCG majors are highlighting a demand slowdown. The management of HUL, Nestle and Tata Consumer are pointing to pain in urban markets while rural sees a gradual recovery. Listen in.
The rural markets have been on the recovery path for some time and continue to recover gradually. And please note that it's about a third of our business comes from rural areas and 2/3 comes from urban areas. In the recent near term, we have seen a certain slowdown in the urban markets. They are continuing to grow, but the growth rate is trending down. And on the whole, therefore, the markets are slightly down compared to where they were, say, a few quarters back. Now, it's a near-term phenomenon, and it could be driven by various macro factors that could be short-term and long-term in nature.
Well, on similar lines, Sunil D'Souza, CEO of Tata Consumer Products, spoke to CNBC-TV18 and said that the demand slowdown was seen across different categories and that other FMCG companies were also highlighting this stress in demand slowdown, especially in the urban sector. Let's listen in.
I do think once the entire Kharif this thing happens, you will see a far more buoyant rural economy. That said, on the urban pace, I wouldn't say that much, but there has been an impact of all the flooding, etc., in various parts of the country. B, food inflation. I think we have not, I would say, seen the full impact. For the middle income person, I mean, food inflation is a reality, and I think that has hit a bit. So, across various categories, if you see, four-wheelers are slowing down. Other competitive FMCG companies are talking about stress in urban. So you look at various indicators, all of them are indicating a little bit of stress.
And here's one more voice. Speaking to reporters, Nestle chairman and managing director Suresh Narayan also said that the FMCG sector is witnessing a slowdown in demand as the middle class shrinks. However, he also pointed out that demand for premium products remained high. The Nestle MD also said that the demand pressure points were coming in from megacities and metros and noted that as opposed to earlier demand slowdowns, which used to last for a quarter, the current slowdown in demand has lasted for the last 2-3 quarters. He also added that the bigger cities were seeing a change in consumer behavior with people preferring quick commerce and e-commerce options, and that is something that Dabur flagged this off, saying that they've had to undertake some sort of channel inventory changes because of the disruption that is being witnessed in the quick commerce space. We discussed this actually with Abanish when Dabur made that comment, and now we've got a whole slate of additional voices from the FMCG space exactly indicating the same. Abanish, morning, good to have you back on. Now, what do you make of it? Everyone from Tata Consumer to Nestle to Lever, everyone's acknowledging there is a slowdown, and it's more pronounced in urban India. Your thoughts? And the critical question is this transitory passing one quarter, or is this something more serious building up?
Sure. Thanks. Yesterday, we had 3 results. So, Pidilite, decent results, 13% EBITDA growth, overall 8% volume growth, 6% in the consumer bazaar. Weak numbers from United Spirits. So, we expect United Spirits stock to correct in the near term. And HUL more or less in line, slight miss in volume, but broader numbers in line. Coming to your question, what we are seeing, no, it is not a doomsday scenario. When the results of Colgate, Britannia, BKG, even Marico or GCPL will come, you will see that there the volume growth is more like 5% to maybe even high single digit. Here what's happening is the urban focus, clearly there's a slowdown. We had pointed in our preview around 3-4 weeks back that because of very high food inflation, urban focused companies are facing the slowdown more. That's why if you see United Spirits, clearly P&A 3% kind of volume decline. I think after many years, many quarters, we are seeing a decline in the P&A of United Spirits. Clearly, that's an urban-focused play. Similarly, Nestle, if you see 1.5% volume decline, again, Nestle is almost 75-78% urban. So coming to Unilever, if you see parts of the portfolio has seen 5% to 9% even volume growth. So if you see the key problem categories for Unilever, wet tea, and Tata Consumer also saw exactly same thing. These are mass consumption, right? So if there is a food inflation, the customer at the lower and mid end is cutting down on definitely tea and soaps, etc. And that's where Unilever saw volume dip. And Horlicks, there was a volume dip. But if you see home care, detergent, liquid detergent, even in terms of the skin cleansing and oral care, HUL has seen 5% to high single digit kind of volume growth. So it's not across all categories. Currently, will be more positive on Marico, BKG, Britannia, Colgate, etc. If you see even HUL in oral care has seen high single digit kind of growth. So it is not FMCG that everywhere there is a slowdown, but urban and clearly where beverage was there the impact has been higher till now. Yes.
Yesterday I was talking to an investor and he was exasperated. He said, well, monsoons have been good. And he said, well, I'm in Bangalore and it's still raining here. So, you know, is it... so are we really sure about a slowdown, a big consumer slowdown? We'll have to find out, we'll have to wait. But of course, you're saying it's not a widespread thing, it's more urban than rural. Abneesh, so how do you, when you say rural and urban, what's the share now and how does one define? Because it's, you know, that number, those numbers will also change, right? Across the board for companies?
Yes, so HUL, Colgate, etc. are on the higher side, more like 35-40%. Rural exposure, while Nestle, which is currently facing the brunt of the slowdown, that has just 22-23% rural. So Imami, for example, somewhere we are positive. We do expect that in second half, Imami should be back to 7-8% kind of growth. So Imami again has high exposure. So Imami, Colgate, HUL, even Britannia, if you see, although they do have urban being high, but they are doing very good work in the Hindi states where in the rural, they are seeing faster growth. So even GCPL, Marico, etc. will be broadly in the 30-32% range. So yes, 30 to 40% is the broad range. Nestle is one of the outliers, and that's why it is facing more pain.
Okay, all right. Abneesh, I think you said you're reasonably positive on BKG, I think so, as well as Marico. I think both those two stocks you like. Anything else that you like from the FMCG pack?
Yes, we like Colgate, we like Britannia. I think most of these companies' results are not yet out. So we will see that Colgate and Britannia, our sense is around 8-9% kind of volume growth for 8% for Colgate and 9-10% for Britannia is possible. BKG, we expect double-digit volume growth. Today, ITC results are there, but nothing very strong results we expect. We expect around 2.5% volume growth in cigarette and 6-7% in the FMCG. So currently more of dividend yield for ITC. We also need to see what BAT does on the balance stake in ITC. Of course, they already said that in the hotel business of ITC, which will say list in Q4, they would plan to exit at some stage. So currently, ITC is more of a dividend yield, but not a very strong growth for us.
Okay, so keep the faith. It's not a doomsday scenario. This is far more granular and probably impacting some of the urban plays more where inflation is biting. Got it, Abneesh? I think that's important to keep in mind. By the way, on margins and also from a stock positioning point of view, we've discussed a lot about the earnings. Just from a positioning and valuation point of view, what would be your topic? You named quite a few plays in terms of better growth. Valuation, positioning, best one or two FMCG stocks to own?
Yes, so I think HUL, most of the negatives are priced in. You did say that the stock has already corrected. So I think the positioning has happened. And ice cream business, if you see, although structurally long-term, we are not very convinced on why HUL should exit this. But a lot of the minority investors will get either a special dividend. We expect almost 15,000 crore kind of valuation easily for this business. It will lead to very high interest if this gets sold. Second option could be that it gets demerged and it gets listed separately. Both options are open. I think in both cases, minority investors will see value unlock or a special dividend. So HUL is looking good. Maybe 1% correction in the near term, but second half, clearly price growth will also come back. So valuation comfort is there in HUL. Valuation comfort is also there in Imami and ITC. So those are the two companies where valuation comfort, reasonable growth. But in terms of high growth, I think Bikaji, Britannia, Colgate, etc. will be on the higher growth rate.
Okay, all right. Thanks a lot, Abneesh, for joining in. Wishing you a good day ahead. And thanks a lot for giving us your view on the sector as well as the individual stocks. Well, it's 9:10, so let's go across to Mitesh for his 9:10 call. Mitesh?
I'll go with a buy on HDFC Bank for targets of 1790.
1790. Got it. Sudarshan, what about you?
Well, buy ICICI Prudential to stop under 735.
All right. Thanks a lot, gentlemen, for joining in and giving us those picks. We'll come back to you as the session progresses. Well, yesterday, Paytm was one of the stocks of the day. Abhishek joins us to tell us what brokerages are making of it. Abhishek?
Well, to begin with, Citi has written on Paytm, they have upgraded the stock to buy from sell and raised the target price to rupees 900 per share. They say that regulatory risks now appear largely behind, and company has announced plans to offer, default loss guarantee to be compliant with the RBI guidelines to their merchant distribution partners where they have given out loans. So in Q2, while revenues were in line, huge reduction in OPEX actually led to significant beat on adjusted EBITDA to Citi's estimates. So Citi has raised their estimates for the coming years as well as the valuation multiple to about 42 times EV adjusted EBITDA. Back to you.
All right. So we'll look at the market open in just a bit from now. And look at what's happening with some of these rates, etc. We'll of course look at Paytm if we can have. Nifty is absolutely flat. It's starting with a 20-odd point, 22-odd point cut, which actually would is not a bad thing. A 50, 60-odd point higher. It's better than a 50, 60 point higher start in an environment like this where. I think it's almost a given that you perhaps will see a dip at some point. So you start a little subdued and then we'll pick up from there. Remember, the market's already come off sharply. So that's essentially the context. 7-8% from the all-time highs on the Nifty, more for the mid-cap and small-cap indices. So that's already happened here. And that's important to remember even as you look at this 1.5% cut overnight in NASDAQ. That market is just starting to come off a little bit from the highs. We got the opening bell coming up on your screens anytime. We'll look at indices and then we'll go to stocks. What do we have? Absolutely flat starts. 24,450 on the Nifty. You've got, 470 taking up a little bit. Let's see. Nifty Bank is up 0.4%, 51,445 on the Nifty Bank. The sensex is starting about 0.15% higher. Mid-cap index is flat to slightly higher. So not very much, but it's up. Market breadth, I think you've got about, 34 odd stocks which are higher and 14 odd lower, 14, 15 stocks are down. So it's mostly up. But I suspect, some of the juice is going to be in terms of these individual earnings reactions and news flow related names. Surabhi.
Before I get to lever, the stock that's really catching the eye is Hindalco with a 4.5% decline straight away. It's not like all other metal stocks are selling off. This is a big cut on Hindalco to begin with. Lever is down about 2.5%. So clearly there is still that disappointment that's showing up despite the fact that yes, the stock has already gone into numbers weak. But then the commentary, the numbers themselves are really weak. So that's showing up. Britannia is down about 0.5%. Tata Consumer, Nestle, basically all of FMCG is sulking. That's the first trend this morning. Hindalco's cut is now almost 5%. So let's keep an eye out on this stock as well. On the upside, on consumer, if there's one shining star, it's Trent. And it seems that there's some churn going on within the consumer space as well as money seems to be shifting around. Trent is up about 1.5%. The other stock is Adani Ports, which is up second best performing stock on the Nifty. And then there is HDFC Bank. It's showing its class, it's showing its move, almost 4.5% up this week, ever since it's sort of standing tall ahead and above others in terms of earnings and asset quality. Very little buying in IT. It's not very pronounced right now. HCL Tech, Infosys, they're trying to flash a little bit of green, but not too much. So basically, the only biggie on the upside is HDFC Bank. And then ICICI Bank is trying to inch up. Let's see if it gets there. SBI is on the flat line. Basically, banks and IT are at the flat line. Where they go, they will take the Nifty with them. But yeah, lever is now down 3.5%. So that's that's saying something that while the stock might have not reacted too well, the fact is that these concerns are well entrenched and they're showing up on the stock.
Well, the reason that Hindalco is down is because Constellium, they came out with a set of numbers overnight and that stock was down close to around 28%. I'm going through a sales note though. They highlight that the correlation between Constellium's results as well as Hindalco's Novelis's numbers, actually there's not a big correlation that we see normally out there. And just to point this out, when Alcoa reported a very, very good set of numbers, the same trading session, you had Alcoa overnight that ended down 5%. After in post-market hours, it was up close to 5%. So that correlation between these companies is not really there, but there was very cautious commentary coming in from Constellium. So that could be one of the reasons that Hindalco is down close to around 4.5%. Sona BLW, well, the street likes that deal. The stock is flying away as we speak. It's up close to around 6%. The railway business that they have acquired could contribute nearly 20% of its total mix in 2027. So that's good news. Aster DM. Stock is up 10% now. Big move, big volumes out there. So a phenomenal move is what we're seeing out there. You like these earnings surprises that you're seeing. Piramal Pharma as well. Last quarter was a little bit softish, but the last quarter of FY24 was very good and they've returned back to their winning ways. So that stock's up close to around 3%. AU Small Finance, well, the street likes quite a bit those numbers. We'll have the management at around 10:30 later today. So that stock as well is up and about. What doesn't the street like? Birlasoft. Stock is down 5% in reaction to its numbers. KPIT as well, I think, is seeing some selling post its numbers. It's now down 7%. Margin for error is very, very limited after stocks have seen a big rally. So that's another one. And, we spotted Sona BLW. Street likes the deal for them, but it seems that they don't like it so much for Escorts because the money that they're going to get may not be able to compensate for the earnings that they were getting from that railway business. So that's why that stock is down 4.5%. Prashant.
So it's, on the index, it's absolutely flat. But there's a lot moving on both up and down side. And by the way, market breadth is negative. 1,200 stocks are down and about 870 stocks are higher at this point in time. So just on the downside, I think lever we pointed out with a 4% cut. So if you can have these up, Hindalco is down 5%. That's a very sharp move down on Hindalco. And that's the second largest volume traded cut. 2 million shares now. Amber Enterprises, day before yesterday, sharply lower, yesterday sharply higher, today down about 2%. SBI Life, Yash was been telling us about the numbers, 4% lower. Birlasoft, I think Nigel mentioned, 5% down. KPIT, Nigel mentioned, 8%. SRF is down 4%. SRF reported numbers in the closing hour yesterday. Escorts is down 4%. And what else? Actually, it's a high volume start. So it's not lacking in volumes at all. Bajaj Housing Finance is down about 2.25%. Varun Beverages is down about 2.25%. Look at IIFL. My God, it's almost under 400 now. That RBI taking the gold loan back, it's basically back to where it was when it was not allowed to disburse gold loans. So all of that gone absolutely from 550 to $400, very, very fast. VIP Industries is down 5%. It's a results reaction. Piramal Enterprises is down 2%. Lodha is down about 2%. So Karnataka Bank is down about 3%. So that's essentially what's coming up. But then volumes will start to taper off if I go down the list a little bit more. Aster DM is up a solid 10% now. It's the second biggest volume-led gainer. AU Bank is up 4.5%. Piramal Pharma is up 4%. Naveen Fluorine, Sonal was talking about the numbers. 4% gain there. There is Godrej Properties, and you'll hear from the management a little later, 3/4% higher, 3% higher for now. Care Ratings is a big mover, 10% pop on Care Ratings, 10.5 actually, 12.94 is where Care is coming up as far as gains are concerned. 361 had sold off a little bit yesterday. It's pulling back about 3% today. Skipper Limited is up about 4%. EPAC Durables is limit up 5%. Syngene is coming up with about a 3.5% gain. So lots and lots of movers up and down, although, there's about 20 points to show for it as far as the Nifty is concerned. Nifty 20 down points on the index right now. Surbhi?
No, I was just saying, because you mentioned IIFL, I was looking at the numbers, and it's very clear that while, of course, gold loan, I mean, that business had its own problem, the other businesses, they simply couldn't fire. On MFI also, there's no growth this quarter because they've probably been a little conscious given the RBI sort of scrutiny, and the other businesses haven't done well. The company posted a loss in the quarter, so just keeping that on the radar as well. It's almost 100 crore loss, and obviously that's sort of hurting the stock price.
Oh, absolutely, and it's just a tough environment. I mean, as far as the regulatory environment is concerned, and of course, generally seems to be a bit of a slowdown as well. Ashwini Agarwal is with us, founder and partner at Demeter Advisors. Ashwini, good morning. Good to have you with us here. Thanks for your time. You've been calling it a bit of a slowdown, at least for market prices, the rate of change for market prices to gain. I mean, you've been calling for caution and moderation there. So it's happening a little bit, although even as we speak, look at the market go, the Nifty, I mean, we're up 25 points, from down 25 to up 25, but a bit volatile as well. What are your thoughts now, Ashwini? Where are we at from the highs? The Nifty has lost about 7-8%.
Morning, Prashant. Thanks for having me here. Yes, I've been kind of cautious for a little bit. So this correction obviously was something that I had been wanting to see for a long time, and I'm glad it's happened because there were a lot of excesses in the market in terms of some sectors, defense, some of the PSUs, a couple of the other names, and we've seen very steep corrections in those names, notwithstanding that the Nifty is down only 7 or 8%. So where are we in the cycle, and how do we look at it? I think it might help to take cues from the September 21 to March 23 slowdown in the market, where the Nifty fell by about, I think, 16-17%, if I'm not mistaken, but individual stocks fell by 70-80%. So my sense is that given the amount of paper flow that we are seeing, given the slowdown in the overall economic activity and very muted consumer demand, especially in urban India, I think that we might be in for a significant time correction. Price correction may be more muted at the Nifty level from here, maybe another 3-4 percentage points, who knows? That's very difficult to call. But I think now time has come to kind of start deploying cash, especially where we believe that earnings growth is a little bit ahead of where the street expectations are. Again, just taking cues from September 23 to from September 21 to March 23, that was again a time where several stocks gave you spectacular returns, and there were others that were down 70-80%. So all you had to do was kind of put your head down, look for earnings, and that's where you made money, and that's what the market today is telling us as well.
Ashwini, hi, good morning. Great to be talking to you again. But that's the question, right? So you said it's time to start deploying money where earnings will be a little better than expectations. But where is that space? I mean, you look all around, consumers bleeding, banks have their own issues on asset quality or some regulatory overhang. You have some minor flashes of brilliance in IT somewhere here and there. But realistically, I mean, if you're looking at the next 6 to 8 months, where do you think the earnings safe haven is?
So, Surbhi, there are a bunch of places. Okay, I'll take some names, and I'll also state my positions there where required. So HDFC Bank, for instance, I don't have any position there for the moment. But I think, the earnings commentary there clearly points to a bottoming out. Now, whether there is a lot of upside to it or not, we'll see. But I think, as a Nifty component, this is probably what will hold the Nifty up rather than bring the Nifty down. So, whatever you want to do with that name on a relative trade basis. In the pharmaceutical space, in the healthcare space, in the chemical space, I think there are several individual stories where a lot of the hard work done over the last 3 to 4 years is now going to pay off. And you will see earnings surprises there because last 2-3 years, the earnings have been very volatile. I mean, we saw a phase of spectacular earnings driven by low raw material priced inventories, and the end market was very tight, which was a 21-22 narrative. And then we saw the 23-24 narrative where you had expensive raw materials and overstocking at the end of consumers. So margins completely collapsed. I think now we are entering a phase which is normal. And in that normal, I think, in some places where, earnings estimates have got completely beaten down, you might see some positive surprises. I think IT is a little more difficult. IT, because I think IT is still not seeing the kind of growth that would justify the valuation that are already baked in. That's my personal view. And you're absolutely right. I mean, on a broader basis, while financials have underperformed, and there might be opportunities there, but financials is a very tricky space because of regulatory overhang and the risk of disruption. So, that one has to be very selective, but this is the time to be selective.
Okay, this is the time to be selective. By the way, Ashwini, in your own portfolio, and have you moved completely to large caps with very few mid-cap, small-cap exposure?
No, I haven't done that, Prashant. So while I do buy the argument that large caps are probably safer for the next 18 months as compared to small caps, I think on a bottom-up basis, I still see opportunities where in the mid-cap, small-cap space, one might make money on a 3-year basis or a 5-year basis. So I'm staying with that. But yeah, I'm also prepared for a fair amount of pain over the next 12 to 18 months. Time correction, if not price correction, in several of those names is entirely possible. So yes, on a broader basis, if people are risk averse, they should be more into large caps. But if you're willing to look out 3 years, then do I find stories where I can make a 20% type of an annualized return on a 3-year basis? I think absolutely. But, will I see a 20% step down before I see that 100% gain over the next 3 years? I don't know. And that's something one has to be prepared for.
Ashwini, where are you on the great consumer debate? We've been discussing it with analysts, with a lot of managements as well, because I think the market was really hoping for a recovery and it's not getting that. It's very, very patchy out here. So would you buy anything right now? Yes, no, maybe, and what part of it?
Survi, this has actually been a very tough one. I was hoping that rural economy will show a turnaround, which it seems to be doing. But I think it's gotten offset by a much bigger slowdown or a worse than expected demand pattern in urban India. And that's kind of been the negative surprise out there. I also think that what's happened is that over the last 3-4 years, you first had a big flush of spending prompted by COVID savings. And the reason I say COVID savings was that people were at home, they weren't going to work, they were probably not buying clothes, they were not eating out, traveling, yada, yada, yada. So you had saved up money, and that kind of led to the first flush of spending. And now I think what has happened is inflation has caught up, especially in services, in healthcare, in education, in travel. I think, and that's kind of eaten into the spending capability of the middle India, especially in urban India. So I think that to me is what's worrying, and I also think that especially in automobiles, for instance, I think there was a lot of pent-up demand which has got served over the last 12 to 18 months, and now I think it's more trending to normal, and that's kind of not as exciting as it was. So long answer to your short question, but I think it's a very mixed environment out there. Do I have some consumer name? Yes, I do, in the tobacco space, for example. And I think in some of the very small companies where I'm hoping to see step up changes in the way market shares have worked for those small companies. But that's really a market share narrative on a stock specific basis as compared to a broad play on demand.
All right. Ashwini, thank you very much. Good speaking with you, and we'll sort of speak again as far as consumer sentiment and consumer demand is concerned. What we'll do is we'll go across to the management of Metro Brands, they're joining us on the show now. The company reported a weak set for the second quarter. Do note this was the fourth straight quarter of sub 10% revenue growth. Nissan Joseph is CEO of Metro Brands. He's joining us now to take some questions. Mr. Joseph, good morning. Great to have you with us here. Thank you very much for your time. We were just, if you overheard some of the conversation earlier with Ashwini, we were talking about how's the consumer doing. That's been top of mind for many, and whether we are broadly across categories seeing a little bit of tapering off. So give us that sense. Not just two or three things. One, Q2 volume growth. What has it been like? More importantly, for Q3, this festive season so far, how is it turning out? Is there a big improvement compared to the same period last year? And what's the mood like? Go on, sir.
All right, so let me take that one at a time. Good morning, Prashant, and thank you for having me. I think when we look at our Q2 performance, we did see business kind of tend to flatten out a bit finally from the lumpiness of the post-COVID era, right? So the post-COVID era has created quite a few lumps as we normalize through it. So that's number one. Number two, we saw the trend pick up in September, like I believe the rest of the market has seen as well. But looking at Q3, everyone's off to a great start in Q3, but we got to be cognizant of the fact that the key festivals that drive the quarter, Durga Puja and Diwali, are all 2 weeks earlier, right? So that's one thing. But the other big driver for us is going to be the wedding season. And in the wedding season, we have a considerable more amount of wedding dates this year than we did last year. So we're quite optimistic. In Q2, one of the things we did see was that the brand that does very well for us in Q2 is Crocs. And, that performed very well for us. So it's showing that the consumer demand is there, but it's probably the lumpiness of what we've had over the few years of COVID. And if you look at our CAGR pre-19, going back to 2019, we're still mid-double-digit CAGR. So, overall, I don't feel like the economy is in trouble. I don't feel like there's a lot of headwinds coming our way. But this is the season that will tell us.
Mr. Joseph, so some numbers will help. I mean, how do you describe or how do you define optimistic? You said trends in the festive season are looking optimistic. So what is the the sales uptick you're looking at? And I think on a full year basis, earlier you were confident of achieving high teens growth. Do you still retain that? And when you say the festive season is looking good, what does that mean? Does that mean 10% sales growth, more than that, a little less than that?
Yeah. Well, I think if you were to just measure it on the 2 weeks, 3 weeks of October, that's not a good way to pass judgment on a whole quarter, number one, and on a 3 weeks that has pull forward festivals, right? So you got to be a little careful in how you look at that. We continue to guide to that 12 to 15% growth on the year. On the overall business, and that means the back half of the year we're counting on it being quite steady and strong for us. The indications are all good. The categories that should be doing well are doing well. Q2 and Q4 typically are the toughest quarters for us in retail in the footwear business. And, we were able to navigate through it despite the lumpiness of the quarter in the first 2 months as opposed to the third month. So overall, the sentiment is looking like it's stabilizing back to what we guided to, and the 12 to 15 for this year. But overall, the long-term growth that we would look at is still in the 15% CAGR.
Oh, so you're no longer looking at high teens, is it? Because I think perhaps at the start of the year, at some point earlier, you were saying high teens, but now you're saying 12 to 15% is a more realistic expectation.
At the end of the last quarter, we guided that this year would be somewhere between 12 and 15. On an ongoing 5-year CAGR basis, we would still feel optimistic about the 12 to 18. I mean, the 15 to 18.
All right. Hi, sir. Let's talk about Fila and Foot Locker. I understand that on Fila, you've reduced losses out there. And in the past, you've said, I think in the next 3 years, you're expecting these brands together to constitute nearly around 1,500 to around 2,000 crores out of revenues. Is that on course? And how long before Fila breaks even?
I don't think I've ever quoted a number on that, just to be fair. The good news is that, we're through most of the Fila liquidations and have taken the relevant, accounting accruals that we needed to do for it. So that's the good news on the Fila thing, which also, as you can tell, impacted some of our gross margins for this period, which then flows through to the EBITDA a little bit on 100 basis points. So that's as far as what happened in Q2. Looking forward, we've launched a small collection of Fila in our Metro Mochi stores, footwear primarily, and we feel very good about it. So that's off to a start. Like we said, this year is going to be a year that we stabilize and start launching Fila in the new avatar that we wanted to go to. And the early indications are that it's doing well for us, despite the fact that Q2 is not the time you launch great product. It's really Q3. So that's coming up, and we're quite optimistic about what that's doing. We're very excited about the Foot Locker launch that we launched last week in select cities. It's off to a great start. And we know that this is the season for Foot Locker in terms of the peak season of buying, but also the fact that, I believe that the sneakerhead community in India is growing rapidly.
Right. Mr. Joseph, good to get that update from you, and good luck with the Foot Locker. On margins, if you can give us a sense, could you give us guidance towards an EBITDA and a PAT margin target?
Yeah, so what we guide to on a long-term basis on an EBITDA is in the 30 range, right? 30% range. And, you know, this year, this quarter, we were not at the 30, but compared to last year at this time, we're pretty much neck and neck to it last year. There's a couple of things that threw it off. One of them, as I mentioned, was the gross margins that primarily came from the FILA liquidation and also an increased spend in marketing. We launched a new marketing campaign in Q2, getting ready for Q3. So those were the two drivers that potentially drove that EBITDA number just a little bit south. I believe it was 100 bips. But having said that, though, all those things, all the other expenses, we've been able to do our usual financial discipline and control. As you can tell, our PAT percentage at the end of it all was in line, both for the quarter and for the half.
30% for 25?
I'm sorry, can you say that again?
For 25, is there a number you want to share with us? What are you looking at? For FY 25?
Sure, 25, I believe that we should be able to hit our 30% EBITDA guidance.
Okay, all right. Mr. Joseph, we'll leave it there. Thank you very much for joining us. Good speaking with you, sir, and good luck. It's always great chatting with you. Let's tell you why Hindalco is down. Nigel, take it away.
Well, Constellium came out with its set of numbers overnight, and the stock was down close to around 28%. There are a lot of messages coming in. Why is Hindalco down? Because normally the correlation between Constellium's numbers and Hindalco hasn't been that great. But it's that part of, that I think the timing of the market as well, where it's a little bit cautious. That's why the street is reading through. Keep in mind, this comes after the positive commentary coming in from Alcoa. And also, we had positive commentary coming in from Hindalco's, one of Novelis's big customers, which is Crown. Let's run you through Constellium's numbers. On the shipment side of things, well, there was a degrowth of close to around 5%. And also in the adjusted EBITDA, we have adjusted for those one-offs of close to around $17 million. It came in at around $127 million, which is down close to around 10% year on year. So both on the volumes and on the absolute EBITDA number, there was a degrowth out there. Why was that? Because they said there was a poor performance in two segments, which is aerospace as well as on automotive. And the commentary going ahead as well is fairly cautious on both these two segments. Because in the aerospace, they're saying there are some supply chain issues. And on the auto space, they're sounding cautious both in US as well as in Europe. Now, this is a negative read-through for Novelis. Why is that? Because auto sector is important for them. It's a higher profitable business. And as a percentage of the total mix, auto contributes nearly around 20% to the total volumes of Novelis. And it will be even higher in terms of EBITDA because it is a more profitable unit. So because of the negative results coming in from Constellium, as well as the negative read-through on the commentary, that's why the street is a little bit cautious. But I just want to say one more point out here. Packaging as a percentage of the total mix for Hindalco is much higher than Constellium. And Constellium sounded positive on the packaging side of things. I think the ratio is close to around 60% for Novelis. So we'll be a little bit cautious in extrapolating this entire blow to Constellium to Hindalco. So just keep that in mind. And as it is for quarter two, Hindalco's already won. There will be some bit of a hit of $30 million. So the street is prepared for a soft quarter two.
Okay, Hindalco right now reeling under pressure. But let's quickly move on to our next management conversation. We're looking at KPIT Tech. The company reported what looked like a steady set of numbers. However, the issue seems to be with what the company is saying on the second half, the guidance. Even the guidance has been retained at 18 to 22%. But the company seems to be indicating that it could probably be seeing its revenues more at the lower end of that guidance band than the higher end of it. Kishore Patil, co-founder, CEO and MD of KPIT Tech is with us now. Mr. Patil, thanks very much for joining in. So what is the primary concern? Why do you expect the second half to be a little softer? The stock is reacting to that today. It's down 6-7%. Is it the auto space, the slowdown that we're seeing in Europe? Why are you cautious?
I think the first thing we have elaborated this, that there are three factors that we want to say. Number one, we have a very strong pipeline, and it is a pipeline across. It is not in. It is in Europe. It is in US. It is in Asia. So the pipeline is there. What we are not very sure is some of that because of delay in certain, I would say, launch of some of these programs. If they get delayed by a quarter, we may lose certain revenues during this year. That was the primary reason we have said that. At the same time, I just want to make it holistic. We have also said that there is a reason that last 2 quarters or 3 quarters, because of the cost savings OEMs were looking at, we have increased our offshoring, and hence our margins have gone up ahead of what we have said in this past. So while we have said that, so it is very interesting. We are one of the few who gave the guidance. We are saying in the guidance, the revenues will be at a little lower end, the profitability at a higher end. That's what basically our commentary is.
Okay, all right. Hi, Mr. Patil. You know, the problem that the street has is, should we be extrapolating this and will we see a softer FY26? Because if we're going to have a weak second half of the year, so I wanted your comment on how FY26 is shaping up. And also on the margin profile. You know, Mr. Patil, over the years, you've done 16, 17, 18, then 19, 20% margins. And because of a whole host of issues, offshoring, utilization, better pricing, various initiatives that you have taken, do you have enough levers to see margins expand, say, in the next 2-3 years as well? Can it improve by 100 basis points, 200 basis points? So comments on both FY26 and margin outlook.
Absolutely. So FY26 typically we come at the end of FY25 because that is what we do. But at the same time, let me say that we have a significant and a strong pipeline. We have very strong conversations, and we see no issues in that. And actually, we have given in detail what are the opportunities and where the challenges are. So in certain cases, if you look at it, markets, there are some OEMs which are in a very good shape. They have got good results, and there we see growth going forward, etc. In other cases which are under pain, they are looking at a significant transformation, and that's where we are in discussion for a very significant kind of pipeline. The issue is what and when it would start. And we are very always coming up front and saying that this is the environment, but nevertheless, we will be in the guidance, profitability will be at a higher and this will be lower. The pipeline and the closures have been good, and it has been across. It is not in a particular geography, but it is also where we have seen a more, if I have to say, flattish growth during this quarter, like Europe. We have a good pipeline.
Okay. And on margins, in the past,
yes, absolutely.
You have improved by 100 basis points, very, very roughly. Every year, you have improved by 100 basis points.
Absolutely.
In the next 3 years,
absolutely. And we are very happy about it. And if you look at it, even this year, we are increasing our overall profitability over last year. That is irrespective of 2 things. During this quarter also, there were 2 things. One is we are one of the few companies who are given the full increments across, and we continue to give that. Secondly, we have given the ESOPs, significant ESOPs, and this quarter we had last quarter the impact was only for 2 months. This quarter there is an impact of 3rd month. So in spite of that, we have increased the profitability for the quarter. The point we are trying to say is we have enough headroom, and we will be in a position to increase the margins over next couple of years.
So margin should be 21% this year. Mr. Patil, morning, Prashant.
No, we are not saying that. We have said that earlier we have given 20.5%. We said it will be a few percentage above that. A percentage means point. It will be between 25.5 to 21 on a higher side. That's what we have said.
And FY26 revenue growth should be 18 to 20%?
We will not comment on that at this point of time. We typically, but what I can tell you that the underlying growth is good. There are 3 reasons why I'm saying that. First is wherever we have a long-term contract, they hold very well, and we see growth in that.
Yeah.
The second is we have entered into certain adjacencies, and we are seeing some good tractions there. And you see some of these which were not growing earlier, and you can see quarter-on-quarter growth in those kind of a thing. And third, which is not what we are banking on, but we'll acquire a certain capabilities through acquisitions which will allow us to accelerate growth further in the new areas.
So there is this QIP, right? For you're raising money, $340 million to, and this is going to be a few acquisitions, not one large one.
Yeah.
So already, targets identified. Should we hear something soon? Could you give us a sense of what this is, what geography?
So typically we are taking an enabling, it's an enabling one. We are not, it doesn't mean that we are going to raise it tomorrow. It's an enabling, which means it allows us to raise the money in next 12 months. We are currently naturally engaged with multiple such opportunities, direct as well as organic, where we need to make investments for significant growth. And in both these cases, I mean, these are active discussions, and we feel reasonably confident that something should happen in 6 to 9 months.
6 to 9 months. Mr. Patil, just leave us with some sense of what areas are you looking at for these potential acquisitions, or as you said, it could be organic or inorganic, but what technologies, what are you exactly looking at?
Give more details, but I can tell you that it will be in adjacencies, which we want to double down on. And that is number one. The second, the most important is on the cost reduction. We want to really double down on cost reduction. That will be certainly important because that is on the top of the mind. And third is certain new technologies which are very important from the compliance and globalization of the OEMs of taking their products. So these are the 3 areas which we have identified and we will invest in.
All right, Mr. Patil, we'll leave it there, sir. Thank you very much. Good luck and hope to speak with you soon again. Appreciate it, as always, here on CNBC-TV18. We'll take a break. We'll have the management of Godrej Properties join us on their second quarter numbers on the other side. Stay tuned. Welcome back. I have to say the market's now taken a dive. We are down 80 points on the Nifty. So keep an eye out on the indexes things stand right now. There you go. So that's a bit of a first decisive move coming in for the day so far. But earnings, of course, keeping us busy. Godrej Properties reported numbers. They've achieved a 51% of the total bookings guidance in H1 of 25. Sonal Bhutra caught up with Gaurav Pandey, MD and CEO of the company, began by asking them if the company will exceed their total bookings guidance in FY25 and how is the second half so far looking like? Listen.
For us, this seems to be going like a dream run. Each quarter is very, very exciting for us. Yes, we've met 51% of our guidance, and we've done close to about 13,835 odd crores, which is much higher than in H1, which is much higher than a full year performance just 2 financial years back. So I think, one of the reasons what we've been able to do differently over the period of time is to try and manage our launch calendar better, which basically means it used to be very Q4-led sort of a lumpy quarter. Historically, we tried spreading it out with, of course, some lumpiness here and there, which is why you saw extremely strong quarter 1. I would say from a relative basis, quarter 2 has been equally exciting for us. It has been a growth over the last QA from a quarter on year-on-year perspective. But yes, I mean, when you see from an industry perspective and all, this is a quarter which, unlike last year in Q2, we have Shraddh in Q2 this year. and that kind of takes away 15 days or so of time of the crucial part of a quarter end closing, which is why you'll see a bit of a spillover effect in quarter three for us and most developers. But yeah, I mean, otherwise it's quite exciting. We were able to push a lot of these launches and were able to easily deliver upon other KPIs as well.
Okay. The other thing is your gross development value. The addition that you had expected was around 20,000 crore rupees in FY25. You've already done 63% of that in first half itself. So that number, is it going to get exceeded versus the guidance? And even for that matter, sales value, coming back to that question again, what is the launch pipeline for second half? Do you think you'll exceed that number as well?
I think you're being persistent to try and understand the guidance. Let me first try and answer that. See, essentially, we've done 50+% of guidance in H1. Historically, what we were noticing that typically H1 is about 37% of the full year, and our best ever H1 has been like 40%. So yes, there is a reasonable probability that we will beat our guidance. We just don't want to give you a sort of a revised guidance right now, but this surely has upside risk to it. Fingers crossed, I think we'll beat the guidance.
Gaurav, you have made that shift from JV-JD model to complete buyout model, right? How has that changed things? Has it made the lead time smaller or shorter? But does it also come up with its challenges? I just wanted to understand what kind of differential in terms of costs, in terms of transition have you seen?
And it's a great question. I think of the last 37 transactions or so we would have done in the last 2 odd years, clearly the largest in residential real estate space. I think barring maybe 1 or 2 projects, everything has been outright for us. And I think on one side, we've clearly benefited from the economic cycle because with the property cycle moving upward, our ability to launch and take price jump higher, the economic interest being higher in the project, we are able to clearly take that benefit to our P&L, which otherwise we would have to share it. But I think let me go a little deeper into the inherent advantages that we are noticing, especially in the current structure of how we see the market. But to begin with, when you look at any project, the number of people that you need to run a project, kind of determines your overhead line. So when you do a project with same amount of people but higher economic interest, your profitability margin tends to start jumping up. So that's one benefit you get apart from economic interest. The second thing we learned during the course of projects that normally when we launch projects, these tend to become better in terms of operating cash flow management because you can easily take a decision on where, subject to, of course, RERA limits, how to withdraw cash. So your cash trapping becomes relatively easier to solve because in JV deals, you have clauses which holds you and your JV partner to maintain a minimum amount of cash flow because you want to hold your JV partner from a financial closure perspective. So I think this is financially more prudent and more gives you better upsides. And, we're clearly riding through that. And also on the market scenario right now, if you ask me, I'm not in a very big favor of JV only for this period of time. And we will, of course, continue to add selective projects because most deals that are lucrative to begin with on JV styles are revenue share deals. And sometimes these deals can be a little tricky because the kind of deal terms that you stitch, if not very accurate and not very confident the market, can swing both sides in a different market cycle. So we feel this is, if we get the deal terms that we want, of course, we'd love to do more JV transactions. But currently, purely from a market opportunity and the upside we are able to create through outright transactions has been quite explosive for us, which is why, Sonal, if you try and see our P&L, while our sales between FY18 and 23 grew by, massive 4x growth, but what is more interesting to see is that sales attributable to GPL in the same period has grown by 10x. And that's purely emanating from the construct of deal structure. So you can almost predict the kind of P&L that you'll see, say, 3 to 4 years from today because of the change in structure.
Take that point. And when you say operating cash flows have also improved, and that is something that we can see in this quarter's cash flows as well. So what is the strategy now? More expansion coming via debt or via the internal accruals? Because even your debt has increased.
See, I think our debt has normally increased. In fact, our net debt is about 0.7. And we've always guided the market that net debt would be between 0.5 to 1:1. But yes, net operating cash flow seems to be extremely in a strong shape. We've seen in H1 this number being at 2,800 crores. and this has been the best ever H1 for us because of the massive explosive growth on the collection side. We saw collections grow by 62% Y-on-Y, which was to 7,000 crores on H1 performance. In fact, net operating cash was about 200% plus. Now, coming to the second dimension, how do we see debt? How do we funnel our growth? I think to begin with, our business will continue to throw a lot of cash. And this is clearly no more a thesis. It's something, action is clearly visible right now. So we would invest this capital and grow. But, as you would be seeing, we also have some thoughts on QIP. So, risk management always has been a sort of a cornerstone for us in terms of managing a balance sheet. So that will only add more capital to fuel growth. But yes, we would only gear up to the level pre-QIP to the level we've always maintained. But post-QIP, of course, this will only going to become even healthier should we decide to move ahead with the QIP plans.
So there's no timeline for the QIP yet? The 6,000 crore rupee fundraise that you'd approved, by when do you think you'll actually execute that?
I mean, let's see. I mean, no specific date in our mind. I mean, we've taken an enabling resolution and, there is not a dire need, if I were to put it very frankly. This is just to augment our capital to fuel even more explosive growth. So we've not really put up a timeline in our mind. We'll see how the markets evolve and take a call.
Well, let's get back to the markets, and Mitesh Thakkar is back with us. Mitesh, we have bounced a wee bit from the lows of the day. I think HDFC Bank is something that people are betting on, and Nifty Bank is trying to put in a bit of a fight. It's now up 120 points. What's your view? Where are we headed from here?
Nigel, I would agree with that assessment. HDFC Bank was also my top call. I think that's one stock which is showing exceptional strength, and that, is an area where, long position should be maintained and explored. And I think even on declines, one safe stock to possibly add on to your long position. So that remains the key factor here. But on the market, we talked about this 24,370, 350 zone. We got 24,341 as the low. So it looks like, we've met the weekly averages. There could be a chance of, some kind of a pullback playing out. But for the timing, I'm not trading the index. Instead, trying to, book profits on the short positions and explore some pullbacks on intraday on stocks with a very tight stop loss. I think that's the way we'll approach it. So I have a buy on ACC with a stop below 2260 or 20 point kind of a risk, and a target of 2380 on the upside can possibly be looked at. And Bajaj Finance, I think, which started this big move yesterday, could see some follow through. So buy here with a stop below levels of 7025 and look for a target of around 7300.
Okay, all right. Thanks a lot, Mitesh, for that. By the way, just want to pull up the Hindalco stock. Now, as we mentioned, the mix for them is very different because they have a higher proportion of packaging in comparison to Constellium. For the time being, the stock has recovered closer to 2% from the low point of the day. And keep in mind, Constellium actually sounded positive on the packaging part of the business, though the better margins come in from auto as well as aerospace, obviously. So we'll have to see how that plays out. Well, Dr. Lal PathLabs, that's the stock in focus. I think the stock actually is under pressure. It's down 2.5%. Q2 revenue was in line. PAT came in better than estimates. The margins improved by around 70 basis points on a year-on-year basis. Do note the company has guided for revenue growth better in FY25 in comparison to FY24. Mr. Banerjee, the CEO of Dr. Lal PathLabs, joins us on the show. Hi, Mr. Banerjee. Good morning, and thanks a lot for joining in. Well, the management has said that FY25 revenue growth will be better than FY24. What numbers should we work with? In terms of pricing, you're saying that you'll keep pricing stable. So it has to be the volume factor that will play out. What is the volume estimate you're working with?
So, we keep the guidance as I have been mentioning for the last 2 quarters, better than last year. If you look at, our H1 performance at 10.5% is ahead of last year growth. And, I think we retain the guidance of having better than last year performance, and all of this without a price increase. Now, having said that, I think the growth is going to come primarily from sample and volume growth, as well as some realization improvement that we continue to see, and we believe which is sustainable going ahead, driven by, better geography mix and product mix that we are able to generate. So one can say that maybe it will be half driven by patient volume and realization improvement. However, if you note, our sample volume, which is another measure of volume, is actually tracking significantly better than the patient volumes, driven by our bundling test offers that we see is getting traction.
Okay, all right. Let's focus on a couple of aspects then. Suburban was a pleasant surprise, I think, for the past quarter. It grew, I think, by around 12%, and margins moved to 20% in comparison with the mid-teens, which is great news. What is the growth estimates you're working with for Suburban? And this margin around 20%, is it sustainable? Because it helps the entire pie then, the consolidated margins as well.
So Suburban, we've been working on, the growth agenda on Suburban for almost 2 years now. I think since the acquisition, there were a few initial setbacks, but I think the team is working quite diligently. And I think we are now starting to see some of the good results start coming up. So I think sustaining the double-digit growth that we have seen this quarter on Suburban is going to be the clear focus. And I think we've been saying throughout that the focus in Suburban right now and overall invest also is on revenue growth, not so much on margins. The margin in Q2 typically is higher than maybe the averages. We've got a bit of fluctuations quarter to quarter. But I would not read so much into the margins because, we get benefit in terms of the, operational efficiency as well as the, scale benefits that we get due to the higher volume in quarter two. So the focus will continue to remain on revenue growth for Suburban, and we'll see whatever, margin profile comes out of it is fine, because the more, the better or the more important number to track would be the company overall margin profile.
So what is that likely to be? Mr. Banerjee, let's get to that then. What is the consolidated margin likely to be? You're pleasantly surprising, or they're more than 30%, but you're still talking about 27%, I think, as a guidance. Is there an upside risk to the guidance that you're giving out?
Again, Q2, as I was mentioning, is one of our better quarters. And, typically the margin structure in Q2 looks higher because of that. And also, if you look at, traditionally, H2 margin profile is lower than H1. So we definitely see moderation from whatever we have delivered in H1. And last year, our overall margin we delivered was about 27.4%. I think we'll end up at similar, maybe slightly better than that margin profile.
So still around the 27% mark on a full year basis. Got that, Mr. Banerjee. Take us through the competitive intensity as well, and where, the industry is on price hikes. I think you've said that you will not be taking any price hikes in the near future, right?
So what we've been saying is that we don't want to take a price increase, at least this year, for sure. But we obviously keep a close eye on how the competitive market is, as well as, what is the cost structure, margin profile, etc. And that will determine what our pricing stance is going to be. But given our strategy of going into the tier 3, tier 4 markets, where affordability is always a key criteria for selection of a brand, we would like to maintain our pricing. In terms of competitive intensity, I think it remains more or less the same as it has been in the past. The only thing that is kind of seen is some of the irrational pricing that we had seen in maybe a few quarters back. That has definitely subsided and stays that way. However, other players are there in the market, whether it are, in terms of other diagnostic chains or, the pharma companies getting into diagnostics, or even hospitals getting into diagnostics, and even the standalone labs that are there, as part of the whole landscape.
Sure.
Intensity on that thing obviously is still there in the market.
Okay, Mr. Banerjee, just a very quick last question. Only 30 seconds left on this conversation. You have a decent amount of cash on the books, right? I mean, you have a nice, comfortable position of 1,000 to about 1,100 crores. So what are you looking at? I mean, how can you be satisfied with just about 11% top line growth, given that you have this cash at hand? Would you be looking at inorganic opportunities? I think you have an organic rollout plan of around 15 to 20 labs this year. Would you be looking to increase that intensity? Just leave us with some thoughts on cash utilization and pushing the growth needle a little more.
So the cash utilization, we have said, that there is obviously some capex, some kind of, dividend, as well as we want to keep something, given that, South we have identified as a geography where we would possibly be looking at inorganic opportunities as well. And in terms of pressing the growth needle, I think once we get this whole, stability in terms of the organic picture, we will obviously be looking at ways and means or how we can maybe step up growth going forward.
We leave it there. Thank you very much for joining us. It's a pleasure having you here on CNBC TV18. Thanks indeed. Well, I think markets have recovered, and we are down about 20 points now from being down about 60 or 70 a little earlier. As we slip into a quick commercial break, here's a programming reminder. It doesn't get bigger than this. Coming up on CNBC TV18 today is a fireside chat between Jensen Huang of NVIDIA and Mukesh Ambani of Reliance Industries. They're speaking at the NVIDIA AI Summit 2024. These two gentlemen will speak about AI's pivotal role in shaping industries and India as an emerging global AI leader.
Welcome back. Let's find out what the latest cues are from the commodity markets. We have Manisha joining in with the latest. Manisha, so what's top of mind today?
Even as we talk about gold and silver and crude oil prices, but we are forgetting that aluminum prices in all of this also have continued to gain in the last week or month. We are looking at prices trading at around four-month highs right now. And this is exactly what the aluminum prices really have done. 5% up in last 1 week, 6% up in last 1 month, and 13% up in the positive for this year until now. Well, there have been various factors which have been supportive for aluminum. To begin with, it has been about strong China buying. Also, when you look at the Shanghai exchange, the futures market, that is, the open interest is at a record high for this particular contract. So that tells you that the interest in sense of futures and spot market is equally on the stronger side there. And the reason for this is that aluminum stocks in China have continued to decline. They actually have come off by 20% from its March highs. It also has to do with the risk of bauxite supplies from Guinea that the markets are worried about. Even that, for that matter, from Australia and Jamaica, we have seen the ore imports continue to see a bit of a downtick there. The Indonesian government in 2023 had banned alumina exports, suggesting the domestic industry to start looking at it in sense of refining and using within the country instead of exporting the resource there. Alumina prices, when you look at that, in the last week hit a record highs, and that is exactly where they are trading into this week as well. When you look at the markets overall, the ratio between alumina and aluminum also have been on the higher side. In January this year, we saw it at around 15%, around $350 a ton. But currently, in the month of October, this is almost double. 25% is the alumina-aluminum ratio right now, is what we are trading with right now. The street is also looking at more strong uses coming in from aluminum, apart from electrification and food and tins and foils, etc. Aluminum now has a very strong usage coming in from electrification and EV and solar panels as well. So that demand also continues to increase on the higher side. The street, of course, is looking at the US Treasury yields, the dollar index trading at around 2.5-month highs as well. And you also have the US presidential elections on 5th of November. And there could be some policy changes globally going forward into that. But with the kind of shortages we're looking at, this is a space to stay invested in.
Okay, all right, Manisha, thank you very much for that. So that's what's happening as far as commodities are concerned. We'll take a quick commercial break here. We're going to come back, and on the other side, it's our special Samvat 2081 Indianomics. My colleague Lada will get chatting with 3 top economists to discuss if Samvat 2081 can overturn the second quarter slowdown. Stay tuned, that's coming up.